Hello everyone, I am Munir Mohammed Munir, teaching assistant at Faculty of Commerce, Cairo University. Today we are going to make final revision in Cost Accounting 2. Let's start by Chapter 7, Flexible Budgets, Direct Cost Variances. Basic concepts. Variance is the difference between an actual and an expected or budget amount. Static or master budget is based on the output planned at the start of the budget period. Static budget variance or level 0 variance is the difference between the actual result and the corresponding static budget amount. Favorable variance has the effect of increasing operating income relative to the budget amount. Unfavorable variance has the effect of decreasing operating income relative to the budget amount. Level 0 analysis is nothing more than the difference between actual and static budget operating income. Further analysis breaks down the level 0 analysis into smaller components. It answers how much were we off. Levels 1, 2, and 3 examine the level 0 variance into more detailed levels of analysis, answers where and why were we off. Simple example. If we just compare operating income under actual results, 700, and operating income under static budget, only $20, difference between 700 and 20 equals to 680. This is the static budget variance, but level 0 analysis, as it is only the comparison or the variance between operating income under actual results and the operating income under static budget. But when we calculate variances for each line item between actual results and static budget, this is level 1 analysis, static budget variance. Flexible budget. Flexible budget shifts budgeted revenues and costs up and down based on actual operating results or activities. Represents a blending of actual activities and budgeted amounts. Will allow for preparation of levels 2 and 3 variances. Flexible budget example. Here, as we said before, level 1 variance, we called it static budget variance, difference between actual results and the static budget. After that, we construct flexible budget. Then we compared it one time with static budget that results in sales volume variance, and we compared flexible budget with actual results that result in flexible budget variance. Here's the difference between the flexible budget and actual results will be explained further. In level 3 variances will explore these figures in details into price variance and efficiency variance. Level 3 variances. All product costs can have level 3 variances. Both direct materials and direct labor have both price and efficiency variances, and their formula are the same. Price variance formula: actual price minus budgeted price multiplied by actual quantity purchased if you are talking about material. Efficiency variance formula: actual quantity used minus budgeted quantity to be used multiplied by budgeted price. Chapter 8: Flexible Budgets, Overhead Cost Variances, and Management Control. First, variable overhead variances. Variable overhead efficiency variance is the difference between actual quantity of the cost allocation base used and budgeted quantity of the cost per unit of the cost allocation base multiplied by budgeted variable overhead cost per unit. So variable overhead efficiency variance equals actual quantity of variable overhead cost allocation base used for actual output minus budgeted quantity of variable overhead cost allocation base allowed for actual output, all multiplied by budgeted variable overhead cost per unit of cost allocation base. Variable overhead spending variance is the difference between actual and budgeted variable overhead cost per unit of the cost allocation base multiplied by actual quantity of variable overhead cost allocation base used for actual output. So variable overhead spending variance equals actual variable overhead cost per unit of cost allocation base minus budgeted variable overhead cost per unit of cost allocation base, all multiplied by actual quantity of variable overhead cost allocation base used. Second, fixed overhead variances. Fixed overhead flexible budget or spending variance is the difference between actual fixed overhead costs and fixed overhead costs in the flexible budget. So fixed overhead spending variance equal actual costs incurred minus flexible budget amount. Production volume variance is the difference between budgeted fixed overhead and fixed overhead allocated on the basis of actual output produced. So production volume variance equal budgeted fixed overhead minus fixed overhead allocated for actual output units produced. Now let's solve a problem on chapter 7 and chapter 8, problem 839. Review of chapter 7 and 8, 3 variance analysis. The Brown Manufacturing Company's costing system has two direct cost categories, direct materials and direct manufacturing labor. Manufacturing overhead, both variable and fixed, is allocated to products on the basis of standard direct manufacturing labor hours. At the beginning of 2014, PL adopted the following standards for its manufacturing costs. Direct materials, £5 at $4 per pound, so cost per output unit will equals 5 multiplied by 4 equal $20 per unit. Direct manufacturing labor, 4 hours at $16 per hour, so cost per output unit will equals $64 per unit. Manufacturing overhead, variable manufacturing overhead at the rate of $8 per direct labor hour, so will equals $32 per unit. Fixed manufacturing overhead, $9 per direct labor hour equals to $36 per unit, Standard manufacturing cost per output unit equals to $152. The denominator level for total manufacturing overhead per month in 2014, 37,000 direct manufacturing labor hours. Beal's flexible budget for January 2014 was based on this denominator level. The records for January indicated the following. Direct materials purchased 40,300 pounds at 3.8 per pound. Direct materials used 37,300 pounds. Direct manufacturing labor 31,400 hours at $16.25 per hour. Total actual manufacturing overhead, variable and fixed, equals to $650,000. Actual production 7,600 output units. First requirement: calculate direct materials price variance based on purchases. Price variance equals actual price minus budgeted price, all multiplied by actual quantity purchased. Actual price was given 3.8 per pound minus budgeted price $4 per pound, all multiplied by actual quantity purchased 40,300 pounds. That will result in 8,060 favorable variance, as actual price is less than budgeted price. Requirement number 2: calculate direct materials efficiency variance. Efficiency variance equal actual quantity used minus budgeted quantity to be used multiplied by budgeted price. Actual quantity used, the direct materials used, 37,300 pounds minus budgeted quantity to be used, calculated as 5 pounds per unit multiplied by 7,600, which is output units, all multiplied by budgeted price of direct materials $4 per pound. So 37,300 minus 38,000, all multiplied by 4, equals to 2,800 favorable variance. Third requirement: calculate direct manufacturing labor price variance. Price variance equal actual price minus budgeted price, all multiplied by actual quantity used. Actual price for labor is $16.25 per hour minus budgeted price given as $16 per hour multiplied by actual quantity used. Direct manufacturing labor was 31,400 hours, so this will result in 7,850 unfavorable variance, as actual price per hour is more than its budgeted price per hour. Requirement number 4: calculate direct manufacturing labor efficiency variance. Efficiency variance equal actual quantity used minus budgeted quantity to be used multiplied by budgeted price. Actual quantity used 31,400 hours minus budgeted quantity to be used is 4 hours multiplied by 7,600 units, all multiplied by budgeted price per labor hour, which is $16 per hour. So 31,400 minus 30,400 multiplied by 16 equals to 16,000 unfavorable variance, as actual quantity used is more than budgeted quantity estimated to be used. Requirement number 5. Calculate total manufacturing overhead spending variance. Total overhead spending variance equal actual costs incurred minus flexible budget amount for the fixed overhead and also for variable overhead. First, actual costs incurred given by 650,000 minus first variable overhead under flexible budget will equals to $8, which is variable overhead rate multiplied by actual direct labor hours 31,400 hours plus fixed overhead, which equals to $9 per direct labor hour multiplied by its denominator level 37,000 direct manufacturing labor hours, so 650,000 minus 251,200 plus 333,000, so the result will be 65,800 unfavorable variance. Requirement number 6. Calculate variable manufacturing overhead efficiency variance. Variable overhead efficiency variance equals actual quantity of variable overhead cost allocation base used for actual output minus budgeted quantity of variable overhead cost allocation base allowed for actual output, all multiplied by budgeted variable overhead cost per unit of cost allocation base. So 31,400 minus 4 multiplied by 7,600, all multiplied by 8, which will equals to 31,400 minus 30,400 multiplied by 8, which equals to 8,000 unfavorable variance. Requirement number 7. Calculate production volume variance. Production volume variance equal budgeted fixed overhead minus fixed overhead allocated for actual output units produced. Budgeted fixed overhead equals to 9 multiplied by 37,000 minus 9 multiplied by 4 multiplied by 7,600 units, which will equals to 333,000 minus 273,600 equals 59,400 unfavorable variance. Now let's move to chapter 16, cost allocation, joint products and byproducts. Joint process flow chart. We have a single production process that results in joint product number 1, joint product number 2, and byproduct, and also results in STEM. It is an output but with zero sales value. Joint cost terminology. Categories of joint process outputs. Number 1, outputs with a positive sales value. as products. Number 2, outputs with a zero sales value. Product is any output with a positive sales value or an output that enables a firm to avoid incurring costs. Its value can be high or low. Main product, output of a joint production process that yields one product with a high sales value compared to the sales value of the other outputs. Byproducts, outputs of a joint production process that have low sales values compared to the sales value of the other outputs. Joint costs, costs of a single production process that yields multiple products simultaneously. A split off point, the place in a joint production process where two or more products become separately identifiable. Separable costs, all costs incurred beyond the split off point that are assignable to each of the now identifiable specific products. Joint cost allocation methods. First, physical measures. Allocate using tangible attributes of the products such as pounds, gallons, kilos. Second, market-based allocate using market-derived data or dollars. Number 1, sales value at split off. Number 2, net realizable value. Number 3, constant gross margin percentage. Physical measure method allocates joint costs to joint products on the basis of the relative weight, volume, or other physical measure at the split off point of total production of the products. Sales value at split off method uses the sales value of the entire production at the split off point to calculate allocation percentage. Net realizable value method allocates joint costs to joint products on the basis of relative net realizable value of total production of the joint products. Net realizable value equal final sales value minus separable costs. Constant gross margin method allocates joint costs to joint products in a way that the overall gross margin percentage is identical for the individual products. Joint costs are calculated as a residual amount. Sell or process further flowchart. We have single production process that result in joint product number 1 and joint product number 2. Then we can make further processing in department 1 to reach final product number 1, and we also can make further processing in department number 2 to reach final product number 2. In sell or process further decisions, joint costs are irrelevant. Joint products have been produced and a prospective decision must be made to sell immediately or process further and sell later. Joint costs are sunk costs. Separable costs need to be evaluated for relevance individually. Byproducts. we have two methods for accounting for byproducts. Number one, production method recognizes byproduct inventory as it is created and sales and costs at the time of sale. Sales method recognizes no byproduct inventory and recognize only sales at the time of sale. Byproduct costs are not tracked separately. Which method should a company use? The production method for accounting for byproducts is consistent with the matching principle and is the preferred method. This method recognizes the byproduct inventory in the accounting period in which it is produced and simultaneously reduces the cost of manufacturing the main or joint products, thereby better matching the revenues and expenses from selling the main product. The sales method is simpler and is often used in practice, primarily because the dollar amounts of byproducts are immaterial. The drawback of the sales method is that it allows a firm to manage its reported earnings by timing the sale of byproducts. For example, to shift its revenues and income slightly, a firm might store the byproduct for several periods and then sell them when the revenues and profits from the main product or joint products are low. Now let's solve problem on chapter 16, which was in quiz number 2 this term. First, let's read the problem. Ahmed Company processes raw milk to produce two products, butter cream and condensed milk. The following information was collected for the month of April. Joint costs of 230,000 gallons raw milk, 1,600,000. Separable costs of processing 50,000 gallons cream into 40,000 gallons butter cream, 1,120,000. Separable costs of processing 150,000 gallons liquid skim into 100,000 gallons condensed milk, 2,080,000. Production 50,000 gallons cream, 150,000 gallons liquid skim, 40,000 gallons butter cream, 100,000 gallons condensed milk. Sales from butter cream 24,000 and from condensed milk 90,000. Beginning inventory 0. Ending inventory for butter cream 16,000, for condensed milk 10,000. Selling price per gallon $16 for cream, $8 liquid skim, 50 for butter cream and 44 for condensed milk. First, we draw the process flow chart. We started with 230,000 gallons raw milk with a joint cost 1,600,000. At the spread off point, after processing raw milk, it results in two joint products, cream with the amount of 50,000 gallons at $16 per gallon, and liquid skim 150,000 gallons at $8 per gallon. Then we make further processing to transform cream into buttercream with separable cost 1,120,000 that result in 40,000 gallons from buttercream to be sold at $50 per gallon. Liquid skim, we also make further processing to transform it to condensed milk with the quantity of 100,000 gallons from condensed milk to be sold at $44 per gallon, and we have separable costs with amount of 2,080,000. First requirement, using the physical measure method, what is the allocated joint costs for buttercream at split off point? So we use the physical units. We have physical units is calculated, or we make the allocation of joint cost at the point of split off point. So at the split off point we have two products which are cream and liquid skim. Units produced from cream is 50,000 gallons, from liquid skim is 150,000. Total 50,000 plus 150,000 equals to 200,000. The weight or the percentage, 200,000 is 100%. So to calculate the percentage of cream, we divided 50,000 divided by 200,000, which will equals to 25%. Liquid skim, 150,000 divided by 200,000, which will equals to 75%. So joint costs allocated will equals to 25% multiplied by 1,600,000, which will result in 400,000, and for liquid skim 75% multiplied by 1,600,000, which will equals to 1,200,000. So the answer of the first requirement, the allocated joint cost for buttercream using a physical measure method will equals to 400,000. Requirement number 2, using the physical measure method, what is the cost of goods sold for condensed milk? First, we need to calculate cost per unit. Cost per unit will equals to total costs divided by number of units produced. So total cost will equal to the part of joint cost allocated to each product plus its separable cost. So we add 400,000 plus 1,120,000. This will equal to the total cost divided by number of units produced, 40,000, which will result in 38. For liquid skim, allocated joint cost is 1,200,000 plus 2,080,000 divided by 100,000 equals to 32.8. Then we can make income statement. Sales revenue for buttercream will equals to 50 multiplied by 24,000 equals to 1,200,000. Condensed milk will equals to 44 multiplied by 190,000 equals 3,960,000. Total sales revenue will equals to 5,160,000 less cost of goods sold 38 multiplied by 24,000 equals 912,000. For condensed milk, 32.8 multiplied by 90,000 equals to 2,952,000, and total cost of goods sold 3,864,000. Gross margin equals to 1,200,000 minus 912,000 equals to 288,000. For condensed milk, 3,960,000 minus 2,952,000 equals to 1,008,000, with total gross margin 1,296,000. So answer of requirement number 2 equals to 2,952,000. Requirement number 3, using the sales value at split off point, what is the allocated joint costs for butter cream? Sales at split off for cream and liquid skim, sales value for cream 16 multiplied by 50,000 equals 800,000. Liquid skim equal 8 multiplied by 150,000 equal 1,200,000. Total 800,000 plus 1,200,000 equals to 2 million. Percentage 100% for the 2 million, so 800,000 divided by 2 million equals to 40%. 1,200,000 divided by 2 million, so equals to 60%. Joint costs allocated, total joint cost 1,600,000 multiplied by 40% will equals to 640,000 for cream. For liquid skim, 60% multiplied by 1,600,000 will equals to 960,000. So the answer of requirement number 3 will equals to 640,000. Requirement number 4, using the sales value at split off point method, what is the cost of goods sold for condensed milk? Cost per unit for butter cream will equals its allocated joint cost plus its separable cost 640,000 plus 1,120,000 all divided by 40,000 unit will equals to 44. For condensed milk, its allocated joint cost 960,000 plus its separable cost 2,080,000 all divided by 100,000 will equals to 30.4. Sales revenue for butter cream will equals to 50 multiplied by 24,000 equals to 1,200,000. Sales revenue for liquid skim will equals to 44 multiplied by 90,000 equals to 3,960,000, with a total of 5,160,000 less cost of goods sold. For cream, 44 multiplied by 24,000 equals 1,056,000. For condensed milk, 30.4 multiplied by 90,000 equals 2,736,000, with total cost of goods sold 3,792,000. Gross margin for cream will equals to 1,200,000 minus 1,056,000 equals 144,000. Gross margin for liquid skim 3,960,000 minus 2 million 736,000 equals to 1,224,000 with total gross margin 1,368,000. Requirement number 5. What is the net realizable value for butter cream? Final sales value for butter cream 2 million less separable cost 1,120,000. So net realizable value for butter cream will equals to 880,000. For condensed milk, final sales value 4,400,000. So total final sales value 6,400,000 less separable cost for condensed milk 2,080,000. Total separable costs 3,200,000. Net realizable value equals 2,320,000 with total 3,200,000. Percentage of net realizable value 880,000 divided by 3,200,000 will result in 27.5%. 2,320,000 divided by 3,200,000 will equals to 72.5%. Joint cost allocated for butter cream equals 27.5% multiplied by 1,600,000 equals to 440,000. Joint cost allocated for condensed milk will equals to 72.5% multiplied by 1,600,000 equals to 1,160,000. Cost per unit for butter cream equals 1,120,000 plus 440,000 divided by 40,000 equals to 39. For condensed milk, cost per unit will equals to 2,080,000 plus 1,160,000 divided by 100,000 will equals to 32.4. Sales revenue for butter cream will equals 50 multiplied by 24,000 equals 1,200,000. Sales revenue for condensed milk equals 44 multiplied by 90,000 equals 3,960,000 with a total sales revenue of 5,160,000. Less cost of goods sold for butter cream 39 multiplied by 24,000 equals 936,000. Cost of goods sold for condensed milk equals 32.4 multiplied by number of units sold 90,000 units equal 2,916,000 with the total cost of goods sold 3,852,000. Gross margin 1,200,000 minus 936,000 equals 264,000. Gross margin for condensed milk equals 3,960,000 minus 2,916,000 equals to 1,044,000 with the total gross margin 1,308,000. So requirement number 6, its answer, cost of goods sold for condensed milk equals 2,916,000. Requirement number 7, what is the constant gross margin percentage for Ahmed company? To calculate constant gross margin percentage, first we calculate total final sales value equals 50 multiplied by 40,000 plus 44 multiplied by 100,000 equals to 6,400,000. Total production costs equal 1,600,000 joint cost plus 1,120,000 separable cost for the first product plus 2,080,000 separable cost for the second product, with total 4,800,000. Gross margin equals 6,400,000 minus 4,800,000 equals to 1,600,000. Gross margin percentage equals to gross margin divided by total final sales value. So 1,600,000 divided by 6,400,000 equals to 25%. Requirement number 8. Using the constant gross margin method, what is the joint cost allocated for condensed milk? So final sales value for buttercream 2 million. Gross margin 25% multiplied by 2 million equals to 500,000. So total production costs equals to 2 million minus 500,000 equals 1,500,000 less separable cost 1,120,000 equals to joint cost allocated for buttercream 380,000. Cost per unit will equals to 1,500,000 divided by 40,000 equals to 37.5. Sales revenue equals 50 multiplied by 24,000 equals 1,200,000 less cost of goods sold 37.5 multiplied by 24,000 equals 900,000. Gross margin equals to 1,200,000 minus 900,000 equals to 300,000. For condensed milk, final sales value equals to 4,400,000. Gross margin 25% multiplied by 4,400,000 equals to 1,100,000. Total production costs will equals to 4,400,000 minus 1,100,000 equals to 3,300,000. Separable costs 2,080,000. Joint costs allocated 1,220,000. Cost per unit 3,300,000 divided by 100,000 equals 33. Sales revenue equals to 44 multiplied by 90,000 equals to 3,960,000 less cost of goods sold 33 multiplied by 90,000 equals to 2,970,000. Gross margin 3,960,000 minus 2,970,000 equals to 990,000. Chapter 18 is Spoilage, Rework, and Scrap. Basic terminology. Spoilage, units of production, either fully or partially completed, that do not meet the specifications required by customers for good units and that are sold for reduced prices. Types of spoilage. Normal spoilage is a spoilage inherent in a particular production process that arises under efficient operating conditions. Costs of normal spoilage are typically included as a component of the costs of good units manufactured. Abnormal spoilage is a spoilage that is not inherent in a particular production process and would not arise under normal operating conditions. Units of abnormal spoilage are calculated and recorded in the loss from abnormal spoilage account, which appears as a separate line item on the income statement. Inspection points and spoilage. An inspection point is stage of production process at which products are examined to determine whether they are acceptable or unacceptable units. The 5-step procedures for process costing with spoilage. Step 1. Summarize the flow of physical units of output. Step 2. Compute output in terms of equivalent units. Step 3. Summarize total costs to account for. Step 4. Compute cost per equivalent unit. Step 5. Assign total costs to number 1. Units completed, number 2. Spoiled units, number 3. Units in ending work in process. Let's solve problem 1839. Physical units, inspection at various stages of completion. Superb Furniture manufactures plastic lawn furniture in a continuous process. The company pours molten plastic into molds and then cools the plastic. Materials are added at the beginning of the process, and conversion is considered uniform through the period. Occasionally, the plastic does not completely fill a mold because of air pockets, and the chair is then considered spoiled. Normal spoilage is 6% of the good units that pass inspection. The following information pertains to March 2014. Beginning inventory 2,200 units, 100% complete for materials, 20% complete for conversion costs. Units started 21,000 units. Units in ending work in process 1,900, 100% complete for materials, 70% complete for conversion costs. Superb Furniture had 1,800 spoiled units in March 2014. Compute the normal and abnormal spoilage in units, assuming the inspection point is at A. the 15% stage of completion, B. 40% stage of completion, C. 100% stage of completion. Under first requirement, inspection at 15%. Work in process beginning 2,200 units. Units started during March 21,000 units. Units to account for 23,200 units. Good units completed and transferred out. Completed as 2,200 beginning inventory plus 21,000 started minus 1,800 spoiled minus 1,900 ending inventory equals to 19,500. Normal spoilage. Normal spoilage is calculated as 6% multiplied by 21,000 units started minus 1,800 units spoiled equals 6% multiplied by 19,200 equals to 1,152 normal spoilage. Abnormal spoilage equals total spoilage 1,800, so abnormal equals 1,800 minus normal spoilage 1,152 equals 648 abnormal spoilage. Work in process ending given 1,900, so at the end total units accounted for 23,200. Second requirement, inspection point at 40%, work in process beginning, given 2,200 units. Also started units are given 21,000 units to account for 23,200. Good units completed and transferred out as calculated before 19,500. Normal spoilage calculated as 6% from 23,200 units minus 1,800 units equals 6% multiplied by 21,400 equals to 1,284, because all units passed the 40% completion inspection point in March. So normal spoilage 1,284 units. Abnormal spoilage equals 1,800 minus 1,284 equals to 516 units. Work in process ending given 1,900. Total units accounted for 23,200. Last requirement, inspection point at 100%. Work in process beginning given 2,200. Started units during March 21,000. Units to account for 23,200. Good units completed and transferred out as calculated before 19,500. Normal spoilage calculated as 6% multiplied by 19,500 equals 1,170, because 19,500 units are fully completed and inspected during March, so normal spoilage equals 1,170. Abnormal spoilage equal 1,800 minus 1,170 equals to 630 units. Work in process ending equals to 1,900. Total units accounted for 23,200. Now let's solve another problem, chapter 18, problem 1841. First, let's read the problem. Weighted average method, inspection at 80% completion. The company is a furniture manufacturer with two departments, molding and finishing. The company uses the weighted average method of process costing. In August, the following data were recorded for the finishing department. Units of beginning work in process inventory 25,000 units. Percentage completion of beginning work in process units 25%. Cost of direct materials in beginning work in process 0. Units started 175,000 units. Units completed 125,000 units. Units in ending inventory 50,000 units. Percentage completion of ending work in process units 95%. Spoiled units 25,000 units. Total costs added during current period. Direct materials 1,638,000. Direct manufacturing labor 1,589,000. Manufacturing overhead 1,540,000. Work in process beginning transferred in costs 207,250. Conversion costs 105,000. Cost of units transferred in during current period 1,618,750. Conversion costs are added evenly during the process. Direct material costs are added when production is 90% complete. The inspection point is at the 80% stage of production. Normal spoilage is 10% of all good units that pass inspection. Spoiled units are disposed of at zero net disposal value. Number 1, for August, summarize total costs to account for and assign these costs to units completed and transferred out, including normal spoilage to abnormal spoilage and to units in ending work in process. Step number 1, calculating physical units. We start by work in process beginning given by the amount of 25,000 units. Started during current period was also given 175,000. Units to account for 200,000. Good units completed and transferred out during current period was given 125,000. Normal spoilage on good units. Normal spoilage percentage is 10% from good units, so normal spoilage on good units equals to 10% multiplied by 125,000 equals 12,500 units. Work in process ending given is the amount of 50,000 units. Normal spoilage on ending work in process 10% of good units, so 10% multiplied by 50,000 equals 5,000 units. Total must be equal to 100,000, so 125 plus 12,500 plus 50,000 plus 5,000 plus x equal to 100,000, so x will equals to 7,500 for the abnormal spoilage. Transfer in costs. As this problem, we solve it using weighted average method. So transfer in costs will be 100% for all line items in the problem. So good units completed and transferred out during current period, transfer in costs 125,000. Normal spoilage on good units also 12,500. Work in process ending 50,000. Normal spoilage on ending work in process 5,000. Abnormal spoilage 7,500 with equivalent units of work done under transfer in cost 200,000 units. Direct materials added at 90%. Completed units. All units took direct material, so 125,000. Normal spoilage on good units. Normal spoilage, its end at its inspection point. Inspection occurs at 80%, so none of the spoilage took direct material, as direct material is added at 90% completion. So normal spoilage will be 0. Work in process ending. Work in process completion percentage 95%. Direct material is added at 90%. So all work in process ending units took direct material, so it is 50,000. Normal spoilage on ending work in process 0. Abnormal spoilage also 0. Equivalent units of work done to date under direct materials is 175,000 units. Conversion costs. Good units completed, as it is completed, so it reached 100%, so under conversion costs 125,000. Normal spoilage, it is only 80% completion, so 12,500 multiplied by 80% equals to 10,000 units. Work in process ending, completion percentage 95%, so 50,000 multiplied by 95% equals to 47,500 units. Normal spoilage on ending work in process equals to 5,000 multiplied by 80% equals to 4,000. Abnormal spoilage 7,500 units multiplied by 80% equals to 6,000. Equivalent units of work done to date under conversion costs 192,500. Step 3. Work in process beginning costs given. Transferred in cost 207, 250. Direct materials 0. Conversion costs 105,000. So total production costs equals 105,000 plus 207, 250 equals to 312,250 plus costs added in current period was also given 1,618,750 for transferred in cost, 1,638,000 for direct material, 3,129,000 for conversion costs, with total 6,385,750. So total costs to account for 1,826,000 for transfer in cost, 1,638,000 for direct material, 3,234,000 for conversion costs. So total costs to account for 6,698,000. Step 4. Costs incurred to date 1,826,000 transferred in cost, 1,638,000 direct material, 3,234,000 conversion cost, divided by equivalent units of work done to date, 200,000 under transferred in cost, 175,000 under direct materials, 192,500 under conversion costs. So cost per equivalent unit equals 1,826,000 divided by 200,000 equals $9.13 for transferred in costs per equivalent unit. 1,638,000 divided by 175,000 will equals to $9.36 per unit for direct materials. 3,234,000 divided by 192,500 equals to $16.8 per unit for conversion costs. Step 5, the last step, assignment of costs. Good units completed and transferred out 125,000 units. Costs before adding normal spoilage 125,000 units multiplied by 9.13 plus 9.36 plus 16.8 equals to 4,411,250. Then we calculate normal spoilage for good units for 12,500 units. 12,500 units multiplied by 9.13 for transfer in costs, 0 multiplied by 9.36 for direct material, 10,000 multiplied by 16.8 for conversion costs will result in 282,125. So total costs of good units completed and transferred out equals to 4,411,250 plus 282,125 will equals to 4,693 and 375. Abnormal spoilage 7,500 units. 7,500 multiplied by 9.13 for transfer in plus 0 multiplied by 9.36 for direct materials plus 6,000 multiplied by 16.8 for conversion costs, with total costs for abnormal spoilage 169,275. work in process ending before normal spoilage, 50,000 units multiplied by 9.13 for transferred in costs plus 50,000 multiplied by 9.36 for direct material plus 47,500 multiplied by 16.8 will result in total production costs for work in process ending before normal spoilage 1,722,500. Then we need to add normal spoilage on ending work in process 5,000 multiplied by 9.13 for transferred in cost plus 0 multiplied by 9.36 for direct material plus 4,000 multiplied by 16.8 for conversion costs, with total normal spoilage on ending work in process 112,850. Then total costs of ending work in process equals to 1,722,500 plus 112,850 equals to 1,835,350. So total costs to accounted for A plus B plus C equals to 4,693,375 plus 169,257 plus 1,835,350 equals to 6,698,000, which equals to total costs to account for 6,698,000. Total transferred in costs equals to 1,826,000. Total costs for direct materials equals 1,638,000. Total costs for conversion costs equals 3,234,000, which equals to all costs we needed to account for must be matching total costs accounted for all items and for the total production costs. By that, we reach the end of our course this term. Wishing you good luck on all your exams.